Joining me now in studio with more is Ben Emmons. He's a founder and CIO at FedWatch Advisors. Ben, welcome.
Good morning, Kristen.
Yeah, great to have you on the show today, especially at a moment where we have seen some changes in the market this week. Let's start with those Fed rate cut projections. Now almost a coin toss. What's behind that?
Yeah, I think it's a few data points. The CPI data was still stickier and stronger than expected, despite the headline a little softer. ISM data was good. Employment data in the ISM data was good. The ADP number that came out the other day was higher than expected. I think these Fed members are looking at the data they got in between where we had to shut down and saying this economy isn't as weak as people think, but inflation is still uncomfortably high, and that I think is on their mind. So you're seeing people that are making more of a case about inflation to not cut rates in December. Then there are people out there saying, well, we should continue to cut rates because of weak employment. That's now only Stephen Myron actually making that case. So I think the market gets a sense of that this Fed has shifted in a different direction, possibly keeping the meeting on hold in December. And that, I think, is causing some pressure here in the market.
What do you think is the right path forward on rates when it comes to that December meeting?
Well, we have to admit that there is some weakness in the labor market because there's not a lot of hiring happening. The unemployment rate stays relatively stable, but it's vulnerable. It could move higher. At the same time, we have inflation that's higher than normal. It is a percentage point above the Fed's target. There's a lot of inflation inside of the CPI itself. A lot of categories are up 5-10% over the past year. And the administration may try to do now something about it with these reducing the tariffs on groceries, on imported food, but that will only alleviate some of it. So we have to see an economy that's stronger and it has just more inflation. So the Fed should actually stay on hold, see how this plays out, and then make the next move.
Let's talk about AI. Of course, we've seen that sector. It certainly was the outperformer amid these record highs that we saw throughout the fall. I think the sector as a whole up more than 40% since that April low amid trade tariffs. But we've seen it come back a bit. Do you think that's warranted?
It would be because, there's concerns here, obviously, that we overextended too fast, too quickly. A lot of money is spent. There's money given to companies that don't make revenue. That is a nightmare from the past. 1999 was a year where a lot of companies that didn't make any revenue gained too much value too quickly and got into IPOs and then became a disaster. And that's obviously OpenAI, right? It's scheduled potentially for IPO. So people are a little bit looking at the past of saying, is this repeating itself? So quickly the word bubble comes up, and that's a negative psychology. So we pull back here. And that will kind of like re-rate the valuations a bit because they were overextended if you think of it historically. But then it is about the economy moving in the direction of an AI economy. And the investment that will be made in AI will be really significant. We talk about hundreds and hundreds of billions of dollars, which creates economic activity. So I think it will be just a temporary move back, a pullback. It may be 5-10%, who knows, but it's definitely not a bear market sort of environment.
Yeah, so to that end, not a bear market sort of environment. Most guests who come on our show have said they might expect some short-term volatility, but long-term the uptrend is intact as we head into year end. What is your view?
So this is view that a lot of fund managers are underweight all these tech names and have to start buying them into year end, and that's why we're getting this rally. We'll see what happens, I think. I'm a little more cautious because there's a reason why people are taking the chips off the table this month. November is the strongest month of the year for the last 15 years. There's not been one November that had a negative return for the S&P. This year's an outlier. So it does tell us something about, I think people are taking profits here and are being more cautious. And I would share that too because you do see parabolic movements in prices of individual stocks. And you don't need a model to see if the price goes like this, that it's going to see a correction. That doesn't mean it's a full outright bubble, but it's definitely, let's say, a correction from the froth that was built in there because just too much expectations for what ultimately can be delivered. So I think be a little cautious and see how it plays out. And let's also see how the economy behaves because we do get all this data again. We had a month of data was zero. So that's an unknown too to the markets today. Unknown what this next GDP data will be, the next jobless claims will be. that could actually cause a little bit of volatility too. We don't know what it means.
And we know amid the government shutdown, right, not only was the data actually delayed, but even companies looking to go public, right? It was hard to get through the SEC when the government wasn't necessarily open. So now that we do see the government back in business, what could that mean for the IPO market and overall sentiment?
Well, there's again market timing here. You know, typically IPOs are really robust when you have a bullish market, when everybody's very exuberant. That's when IPOs tend to come one after the other. Because why? Well, people were willing to buy the stocks the days that we got a good, strong market. So, you know, a bit of a pullback here is not helpful in that way. So I think the IPO market may be a little sluggish to start, just because of, you know, a bit of a negative sentiment that we have. But then there's the outlook, and it's more about like, well, if it continues to be in this direction of more spending and investment in AI, or more happening in the economy, you're going to see more IPOs. It's going to happen, yeah.
And you don't see that investment in AI pulling back anytime soon?
The only way that would pull back is that if you're getting legislation in Congress that's going to say, look, it's great AI, but we cannot have the threat to our jobs so significantly that we have to put a limit on the development of the technology. Now, there are bills floating in Congress, both the House and the Senate, bipartisan and partisan, that have that same idea. We have to protect American workers from AI. So that is something to watch, because if you really think of a bubble, and I'm talking here now the Dutch bubble, the tulip bubble, the way that ended. You know, here at the New York Stock Exchange, the Dutch settlers came here first, right? The Dutch citizen here. That ended because the Dutch government put regulation in place how these auctions and tulip bubbles happened, and that limited the price appreciation. That's the way the bubble ends in this way too. It limits the price appreciation because we're putting limits on AI to protect American workers. It's just to be watched how that will play out, but I think it's in the mind of investors that people are paying attention, like this technology is rapidly advancing. If it has negative effects on the economy, then there will be bipartisan calls for like that has to change.
Ben Emmons, he's a founder and CIO at FedWatch Advisors, joining me in the studio this morning. Ben, thank you as always.
You're welcome, thank you.
Great to have you.